love to know if Chomsky believes that cryptocurrencies can really decentralize the financial world, and if that's even beneficial to society at large.
Decentralization of financial institutions?
Via cryptocurrencies, or the popularization of them.
Well, this is a question that arises at many different levels, but one of them has to do with central banks. The other has to do with investment banks, banks altogether, so on, private financial institutions. Uh, Central bank is essentially a government institution, though it's supposed to function independently of the government. And these are different questions. Modern state capitalist societies, I don't think could function without some kind of central bank. On the other hand, the individual banks have way too much power. They're probably harmful to the economy. They've grown enormously in the past 40 years. If you go back to 1950 and 1960, first of all, banks were tightly regulated, and they were basically closely connected to the real economy. A bank was a place where you could put extra money if you didn't want to use it right now. You could go to the bank for a loan to buy a car, things like that. That's what a bank was. Not now. After 40 years of neoliberalism, banks just have an overwhelming role in the economy. There's a huge amount of trading that goes on, which has nothing to do with the real economy. In fact, it's often, and of course, they're subject to continued crises and collapses. In fact, they probably even couldn't survive without a major public subsidy. The International Monetary Fund did a study a few years ago of the major US banks, I think the top 6 or so banks, and asking simply where does their profit come from? It turns out their profit comes overwhelmingly from a government insurance policy, a policy that in its public version is too big to fail. What it means is an implicit guarantee by the government that we're not going to let you collapse because you're too big. That leads, of course, to regular huge bailouts after a crisis. But much more than that, it means the banks have access to cheap credit. They get inflated credit ratings. They can borrow on cheap terms. They can the investment banks can engage in risky activity, which is quite profitable in the short term. And if it crashes, the friendly taxpayer will come in and bail them out. So they have the numerous advantages of that kind. It's hard to put a number on them. Bloomberg Business Week did an analysis and estimated on the basis of the IMF figures that might amount to maybe $80 billion a year of subsidy. That's a fair amount of money. It's not clear that, and more recent studies indicate that financial institutions contribute to the economy up to a certain level. Beyond that, they probably harm it in many ways. It's pretty interesting that economists have not done very much study of this. Back after the crash of 2008, 2009, crash was caused by predatory lending methods of big investment firms and banks, which were permitted by the deregulation, the massive deregulation of the Clinton administration. Robert Rubin, Lawrence Summers, others said, deregulate everything, which led to real criminal behavior on the part of the banks. When it all crashed, the government has to step in and bail them out. It was the worst of periodic crashes since Reagan. There weren't many before because things were controlled. There were some reflections on this by leading economists. I remember an article by Robert Solow, Nobel laureate economist, very smart guy, in Daedalus, the Journal of the American Academy of Arts and Sciences, in which he raised the question whether the huge financial institutions are a benefit or a drain on the economy. And he pointed out that economists had given very little study to this, which is kind of striking because, especially over the 40 neoliberal years, they just become an overwhelming part of the economy, but they didn't fit into the models that economists were looking at. And he tried to give a back of the envelope calculation and concluded they're probably harmful. There's much more study now, which I think gives greater weight to that conclusion. And there are many ways of cutting back their massive oversized role. One very straightforward way is just a financial transaction tax, small tax on every financial interaction. Doesn't for the sum of money that would be collected is huge, be a huge benefit to the. It goes right to the government, which could be used for productive purposes for the bank. And what it would do is sharply cut back trading that is irrelevant to the economy. An awful lot of the trading that goes on, much of it automated by now, is just I can make a little bit of money by moving something from here to here, so let's do it. There's nothing to do with the economy, enriches various extraordinarily rich segments of the economy. And all of that could be cut out just by simple transaction tax, financial transaction tax. It would move the financial institutions closer to having something to do with the real economy. But even beyond that, it's a question whether they shouldn't be broken up. Why should they be bailed out every time they crash? Why not break them up? In fact, why not put them under popular control? Why not have public banks? And why not have the post office be used as a simple bank, which people could use because it's right there and you put money in it, take money out. There are lots of ways of cutting back on the extraordinary power and basically harmful role of these huge institutions. I think those are steps that can easily be taken and should be. Not in the longer term, you can ask what are these institutions about altogether, but that has to do with the nature of state capitalist society.